The turtle's edge, how steady beats smart. It's been often said that investing is simple, but not easy. The simplicity lies in the core principles, which are timeless and accessible to all. The difficulty lies in the execution, in maintaining the required discipline when human nature and a noisy world are pulling you in the opposite direction. Today, I want to illustrate one of the most powerful of these principles, a demonstration of how ordinary, steadfast discipline can triumph over what passes for extraordinary genius in the financial world. We're going to follow a simple, almost boring strategy on a journey through one of the most turbulent and dramatic quarter centuries in modern financial history. To make this story tangible and grounded in reality, we will track a very specific real-world measure, the FTSE All-World Index. This isn't a hand-picked selection of my favorite companies. It's a mirror of the entire global stock market, encompassing thousands of companies from the United States to the United Kingdom, from Japan to Brazil and South Korea. It is, in effect, a barometer for the health and value of global business itself. When global business does well over time, this index reflects that. When it stumbles, the index stumbles with it. Our story begins with this index at a point of peak euphoria. It's the final day of the 20th century, December 31st, 1999. The world is gripped by Y2K fears, but in the financial world, a different, more potent mania has taken hold, the dot-com bubble. The prevailing talk was of a new economy where old-fashioned rules like profits, dividends, and price-to-earnings ratios were considered relics of a bygone era. Companies with little more than a website, a catchy name, and a mountain of venture capital were achieving billion-dollar valuations. It was, by any sensible measure, a time of collective insanity. It was, without a doubt, the very worst possible moment for a novice investor to take their first step into the market. But that is precisely where our story starts. This is the crucible in which our simple strategy will be tested and tempered. Imagine an investor, let's call her Grace, who resolves, on that fateful last day of 1999, to follow a simple, unyielding plan. Every single day the London Stock Exchange is open, she will invest £10 into a low-cost fund that tracks this FTSE All-World Index. Not £100 one week and nothing the next. Not £500 when she feels optimistic after reading a bullish headline. Just £10 every day, rain or shine, boom or bust. And to make this story even more stark, to prove the resilience of the principle itself against the worst possible conditions, let's assume she has impossibly bad timing, mechanically buying at the daily high. She begins on December 31st, 1999, buying her first 10 of the entire world at the market's absolute peak. Part 1, The Crucible of Fire, the dot-com bust, 2000 to 2003. Almost immediately, Grace's resolve is tested in a way few investors have ever experienced. The air begins to leak out of the bubble with a slow, sickening hiss. The FTSE All-World Index, heavy with the inflated tech and telecom stocks of the era, begins a brutal and protracted decline. From its peak at the close of 1999, the index would fall approximately 44% by the time it finally bottomed out in the spring of 2003. Headlines screamed of bankruptcies and incinerated fortunes. Iconic names of the era like Pets.com, Webvan, and WorldCom vanished into thin air, becoming symbols of the era's breathtaking excess. For Grace, the statements arriving in the mail were a bleak chronicle of failure. She was doing everything the so-called experts would later tell you not to do, buying high, and then watching her holdings go lower. By the end of 2001, she'd invested over £5,000, but her account was likely worth less than £4,000. The psychological toll was immense. The noise from financial media was deafening, a constant drumbeat of doom telling her to cut her losses, that the system was broken, that the old rules were dead, and that she was a fool for persisting. A market timer, someone who believed they could outsmart the market, would have been long gone, crystal clear in their vindication. They would have felt brilliant. But Grace did not listen. The £10 investment continued, automated and unemotional. Unseen by her on those grim quarterly statements, this was the secret, humble beginning of her ultimate success. During these terrible years of pessimism, her fixed £10 was buying more and more units of the global index with each passing day. When the FTSE All-World was down 30%, her £10 purchased 30% more of the world's great companies. the GEs, the Toyotas, the HSBCs, the Novartises than it did at the top. When it was down 44%, she was acquiring nearly twice the stake for the same money. She was not panicking. She was quietly and systematically acquiring ownership in world-class businesses at a fire sale. The despair of the masses, reflected in those falling index levels, was silently building the unshakable foundation for her future wealth. Part 2. The Ascent and the Great Flood. The Bull Market and the Financial Crisis, 2003-2009. Slowly, almost imperceptibly at first, the sun began to rise again. The market began a long, powerful recovery starting in 2003. The losses of the dot-com bust were gradually erased as a new bull market took hold, fueled by low interest rates and a booming global housing market. The FTSE All-World Index began a steady climb. Grace's statement, once a sea of red, steadily moved into positive territory. The power of her accumulated shares, bought cheaply during the bust, now began to show their worth. By the peak in October 2007, Grace's story seemed to be one of vindication. Her total contributions had grown to roughly £19,500. Her account value, tracking the index's robust recovery and rise, might have reached £24,000 or more. She was solidly in profit. The noise, which was so negative for so long, turned overwhelmingly positive again, celebrating the financial engineering genius of the banking sector and the seemingly unstoppable rise in global property values. It would have been easy for Grace to feel smart, to believe the good times were a permanent new reality and that her discipline had been proven right. Then, in 2008, the floor fell out from under the global economy with a violence that made the dot-com bust seem almost orderly. The great financial crisis, triggered by the collapse of Lehman Brothers, exposed a rotten core of subprime debt and staggering over-leverage within the global banking system. It brought the entire financial architecture of the developed world to the very brink of collapse. This was a storm far more severe and systemic than the dot-com bust. Headlines now foretold a second Great Depression. Credit markets, the lifeblood of the economy, froze solid. The FTSE All-World Index was eviscerated, falling a staggering 53% from its 2007 high to its terrifying low in March 2009. For Grace, the statements were a bloodbath. From its 2007 high, her account plunged. At the lows, her total investment of over £23,000 was now worth perhaps a mere £16,000. She had given back all her hard-won paper gains and was once again sitting on a painful, real loss. The pain was more acute this time. She had seen the profits, she had felt the validation, and now it had all vanished into thin air. This was the ultimate test of her quiet discipline. Every instinct in her body, every talking head on the television, every fearful conversation with friends would have told her to run, to preserve what little was left, to admit defeat. But her plan did not flinch. The £10 investment continued, a tiny, defiant lifeboat in a hurricane. Day after day, through the worst financial panic in 80 years, she was steadily, mechanically buying the world's businesses at prices not seen in over a decade. Her £10 in late 2008 and early 2009 was buying units of the FTSE All-World Index at a massive, once-in-a-generation discount. This period of maximum fear and despair, when the very future of capitalism seemed in doubt, was, for her future wealth, the period of maximum opportunity. She was building the second, and most crucial, layer of her fortune. Part 3. The long grind higher and the sudden shock, 2010 to 2020. The recovery from the great financial crisis was slow, grinding, and fraught with new anxieties. It was not a smooth, confident rally. The European debt crisis of 2010-2012 threatened to break up the Eurozone, causing violent market swings with every summit and bailout announcement. The U.S. had its own self-inflicted wounds with debt ceiling debacles, leading to government shutdowns and an historic credit rating downgrade. Fears of a Chinese hard landing periodically rattled markets. But Grace's plan was impervious to geopolitical anxiety and macroeconomic headlines. The £10 went in, month after month, year after year. Now the magic of compounding, fed relentlessly by her purchases through the downturns, began to work in visible earnest. Her account value climbed, not in a straight line, but in a persistent, jagged upward trend, what I like to call the bumpy escalator. Each time the market corrected on some bad news, it would fall, but the low was higher than the last major low. Each time it recovered, the high would reach a new peak. By 2015, her account, fueled by over £39,000 in contributions, might be worth £55,000. By 2017, it could be £75,000. The momentum was building in a powerful, undeniable way. The statement at the end of 2019 would have shown a portfolio worth over £1,000. The journey seemed to be smoothing out. Then, in early 2020, a shock arrived from an entirely unexpected vector, a global pandemic. The COVID-19 virus spread worldwide, and governments took the unprecedented step of shutting down large portions of the global economy to save lives. The market, in a matter of brutal weeks in February and March, experienced a drop of stunning speed and violence, falling 34% faster than even in 1929 or 2008. The FTSE All-World Index reflected this global standstill. Grace's account, which had grown so steadily, suffered a sharp drawdown, wiping out over £3,000 in paper wealth in a heartbeat. It was a brutal, if brief, reminder of the inherent and unpredictable risk of the equity market. But what did Grace do? She did nothing different. The £10 investment went in. There was no meeting, no frantic call to her broker, no recalculation of her life's plan. The automation of her discipline carried her through. And because the world's central banks and governments responded with the largest peacetime fiscal and monetary stimulus in history, the subsequent recovery was the fastest in history. The dramatic dip was bought, and her plan, which never for a single day stopped buying, captured the entire rebound. By the end of 2020, remarkably, her account had not only recovered, but reached new highs. The V-shaped recovery, in all its improbability, rewarded the steadfast. Part 4, the final test in the home stretch, 2021 to 2025. The journey, however, was not yet over. The massive stimulus, while saving the economy from a depression, unleashed the next challenge, a wave of inflation not seen since the 1980s. In 2022, Russia's invasion of Ukraine exacerbated the problem, spiking energy and food prices to painful levels. Central banks were forced to aggressively raise interest rates, ending the era of free monies that had defined the post-2008 world. This caused another sharp correction in 2022, particularly in the technology stocks that had led the prior bull market. It was a different kind of decline driven not by systemic fear, but by the cold, hard math of rising discount rates. Yet, through it all, the steady drumbeat of investment continued. Grace's capital base was now so large that each new £10 purchase was a smaller relative addition, but the compounding of her enormous existing holdings was the powerful, unstoppable engine driving her wealth ever higher. The dividends from thousands of companies were being reinvested, buying more shares. The plan was on autopilot, cruising through the latest bout of turbulence. We now fast forward to our endpoint, October 31st, 2025, a journey of nearly 26 years through some of the most dramatic events in modern history. Let's now look at the final ledger for Grace's remarkable, simple, and quiet journey. Total number of trading days, approximately 6,500 days from December 31st, 1999 to October 31st, 2025. Total capital invested, £10 per day multiplied by 6,500 days equals £65,000. Now, for the results based on the actual FTSE All-World Index. This is critical. We are looking at the total return version of the index, which assumes that all dividends paid by those thousands of global companies were meticulously reinvested back into buying more shares. This reinvestment is the silent engine of compounding. From its peak on December 31st, 1999, to a projected level in October 2025, the total return of the FTSE All-World Index has been approximately 7.2% per annum. After investing £65,000 over this time, the power of compounding at that real-world rate would have grown Grace's portfolio to a value of approximately £175,000. Let that sink in for a moment. Our investor Grace, who started at the absolute peak of a historic bubble, who bought at the worst possible time every single day, who lived through the dot-com bust, 9/11, the great financial crisis, the European debt crisis, a global pandemic, a major European war, and an inflation spike, has seen her £65,000 in total contributions grow to £175,000. Her total profit is £110,000. She has nearly tripled her money, not through speculation, but through ownership. The annualized return of 7.2% is the real-world result of owning the entire global market through all its turmoil and triumph. It is the return for being patient and disciplined, for being a business owner rather than a stock speculator. Now let's talk about the ride, because it was anything but smooth. The volatility, as measured by the difference between the annual high and low of her account, was often extreme. In the panic of 2008 to 2009, her account likely swung violently, with an intra-year drop of over 40%. The emotional whipsaw would have been devastating to anyone watching the ticker. In 2020, she experienced a similar gut-wrenching swing, losing over £3,000 in value in a matter of weeks. Even in calmer years, 5 to 10% swings were commonplace. The key lesson is that by not trying to time these swings in the FTSE All-World Index, by simply continuing her purchases through the fear and the greed, she ensured that she was always positioned to benefit from the eventual recovery to new highs. The volatility, which is the nemesis of the short-term speculator, was the silent, loyal friend of the long-term accumulator. She was the turtle, slow, steady, and ultimately victorious. The 5 lessons from Grace's journey. So, what are the timeless lessons we can draw from Grace's quarter-century of quiet discipline? Lesson 1. It's not about timing the market, but time in the market. This is the cardinal, non-negotiable rule. Grace started at the worst possible time for the FTSE All-World Index. But her 25-year time horizon rendered that terrible timing utterly irrelevant. The market's long-term upward drift, powered by global economic growth, human innovation, and corporate profitability, simply overwhelmed her initial mistake. The most important thing is to get started, not to wait for the perfect moment, which is a mirage that only appears in the rearview mirror. Lesson 2. Unshakable discipline trumps flawless brilliance. Grace's strategy required no intelligence, no market forecast, no economic opinions, and no constant monitoring of financial news. It required only one thing: unshakable, robotic discipline. In investing, a simple strategy consistently executed will, over the long run, almost always beat a brilliant strategy inconsistently followed. The genius who jumped in and out based on the news, who tried to sidestep the 2008 crash or the 2020 pandemic drop, likely ended up with far less than Grace. She was smart by being consistently not stupid. Lesson 3. Volatility is a mechanic, not a spectator sport. The wild, gut-churning swings in the market were not just something for Grace to watch and fear. For her, they were the fundamental mechanical process by which her wealth was built. When prices fell, her fixed investment bought more shares. When prices rose, her existing holdings grew in value. She used volatility as a tool, systematically turning the market's periodic bouts of fear into her own future gain. This is the pure, unadulterated essence of pound-cost averaging. It is the process of being greedy when others are fearful, automated. Lesson 4. You are your own worst enemy. The single biggest risk to Grace's plan was not a recession, a crash, or a pandemic. It was Grace herself. The temptation to stop investing in 2002, to sell in panic in 2009, or to try and get clever in 2020 would have been overwhelming. Had she ceased her purchases during any of these downturns, her final result would have been drastically poor. Her quiet edge was her ability to ignore the terrifying news and the voice in her own head, and to stick with her simple, sound plan. The enemy in investing is not the market, it is the investor. Lesson 5. The market is a master of disguise, but business is business. In 1999, the market was disguised as a sure thing, a can't-lose new paradigm. In 2009, it was disguised as a catastrophic failure, a broken system. In both cases, the disguise was a compelling but ultimately false narrative. The underlying reality was that the global economy, represented by the companies in the FTSE All-World Index, was going to continue to grow, adapt, and become more valuable over the next 25 years. By focusing on that underlying reality, by owning a diversified piece of the world's great businesses, and ignoring the market's ever-changing costumes and moods, Grace ensured she participated in that long-term growth. The loud conclusion from this quiet story is this: you do not need to be a financial expert to be a successful investor. In fact, thinking you are one can often be your greatest handicap. What you need is the humility to accept that you cannot predict the future, the wisdom to own a diversified piece of the world's productive assets through a low-cost index fund, and the profound, almost stubborn discipline to contribute to it regularly, through thick and thin, for decades. It is a quiet, boring, and undramatic path. It won't make you the life of the cocktail party, and you'll have no exciting trading stories to tell. But it just might, with time and patience, make you financially independent. In the noisy, distracting casino of the market, where everyone is trying to be a smart hare, Grace's quiet, steady, turtle-like discipline was, and always will be, the ultimate edge.